Ever dreamt of owning a slice of Apple, or maybe being a micromogul in Microsoft? The stock market can make those dreams a reality, but for many beginners, it can feel like a confusing jungle. You hear terms like brokerage, ownership, and platforms like eToro, but what exactly does it all mean? Do you truly own the stocks you buy on eToro? Buckle up, because today we're untangling that question and giving you a clear picture of how eToro works. Now, traditional stock ownership means you have a certificate with your name on it, proving you have a piece of the company. This gives you voting rights and a claim to any profits the company makes. But the world of finance is constantly evolving, and online platforms like eToro offer a different way to invest. So, what happens when you hit buy on a stock on eToro? There are two key things to understand: ownership and CFDs. Let's break those down. For stocks in the US, eToro says on their website that when you buy a stock, you actually own the underlying asset. They use a trusted partner, Apex Clearing Corporation, to hold those shares on your behalf. This means you'll receive any dividends the company pays out, just like a traditional stock owner. However, there's a catch. You don't get a physical certificate or voting rights, except for US stocks, which eToro is hoping to expand in the future. Here's the analogy. Imagine eToro is like a super secure vault where they keep all their clients' stocks under lock and key. You don't have your own personal box, but your share is safely stored there, and you get the benefits of owning it. Now, things get a bit more complex with contracts for difference, or CFDs. These are essentially financial instruments that track the price movement of an underlying asset, like a stock. When you buy a CFD on a stock, you're not actually buying the stock itself. Instead, you're entering an agreement with eToro to pay the difference between the opening and closing price of the stock. Think of it like this: you and a friend make a bet on the price of a stock. If the price goes up, your friend owes you the difference. If it goes down, you owe your friend. With CFDs, eToro acts as your friend, but it's a regulated contract, not just a casual bet. The key difference here is ownership. With a stock purchase, outside of CFDs in the US, you own a part of the company. With a CFD, you're simply speculating on the price movement. This can be a riskier strategy, so it's crucial to understand the difference before you dive in. So, which one should you choose? Well, that depends on your investment goals. If you want to be a long-term investor and benefit from potential company growth and dividends, then buying stocks outside of CFDs might be the way to go. If you're more interested in short-term price movements and potentially higher returns with higher risks, then CFDs could be an option, but remember, they're not for the faint of heart. eToro offers two ways to invest in stocks: owning the underlying asset for US stocks outside of CFDs, or using CFDs. Do your research, understand the risks involved, and choose the method that aligns with your investment goals. Remember, the stock market can be a wild ride, so it's always wise to start small, diversify your portfolio, and never invest money you can't afford to lose. With that said, thanks for watching, and until next time, happy investing.